We calculated WACC using the standard formula, deriving the cost of debt using the interest expense method for LVMH, Hugo Boss, and Prada. This ensures comparability by using financial statement data instead of fluctuating bond prices. This provides a standardized borrowing cost. Hermes is different as it relies mainly on lease liabilities rather than traditional debt, and so Hermes required an alternative approach, which is explained later. The cost of equity was determined using CAPM. Since the firms operate in similar markets, a uniform market risk premium was used to isolate firm-specific risk. The market risk premium was sourced from PitchBook, using a 3-year average of the 10-year bond yield for the risk-free rate. We also examined WACC sensitivity to capital structure changes. Doubling debt lowers WACC due to the tax shield on interest, while doubling equity increases WACC as equity is more expensive than debt up to a certain point. The €1.48 trillion luxury goods market relies heavily on luxury cars, personal goods, and hospitality. The sector faces a couple of key risks. Because luxury goods are discretionary purchases, they are very sensitive to economic downturns and inflation. Brand reputation is critical, with counterfeiting and PR scandals threatening exclusivity in sales. Shifting consumer preferences also drive demand for sustainable and digital luxury, pressuring brands to adapt. Geopolitical and FX risks expose firms to currency fluctuations, tariffs, and trade restrictions, while supply chains face growing pressures to be fully ethical and sustainable, which increases operational challenges. In terms of capital structure, the average debt-to-equity ratio in the luxury sector is 43.8%. This reflects a preference for equity over debt financing.
GSK's 4.25% WACC is low due to the defensive nature of pharmaceuticals, with stable demand reducing market volatility. Its low beta 0.38 and cost of equity 4.47% reflect this stability, while its debt-heavy capital structure 21.21% benefits from low borrowing costs 3.9%, further lowering WACC. However, the industry has unique risks. Regulatory hurdles like the FDA and EMA delay drug approvals, while patent expirations increase competition from generics, cutting revenue. Pricing controls and insurer negotiations limit pricing power, making cost efficiency crucial. High R&D spending adds financial pressure, requiring continuous reinvestment. Despite these challenges, GSK's low-risk profile and debt reliance help maintain a stable, low-cost WACC, supporting long-term investment in drug development. The luxury and pharmaceutical industries face fundamentally different risks. Luxury is cyclical and consumer-driven, relying on exclusivity, brand perception, and discretionary spending. Pharmaceuticals are regulated and R&D intensive, with revenue tied to drug approvals, patents, and consistent healthcare demand. Luxury brands control pricing, while pharma is constrained by government regulations and insurer policies. Economic downturns impact luxury demand, whereas pharma faces long-term risks like patent expirations and price controls. Supply chain risks also differ. Luxury firms source rare materials, while pharma manages global logistics and strict manufacturing regulations. Foreign exchange fluctuations heavily impact luxury sales, while GSK benefits from regulated price stability. These contrasts apply to all luxury firms, as the industry's structure differs fundamentally from the pharmaceuticals, shaping their risk and financial profiles in entirely different ways. Hermes's handcrafted production ensures exclusivity but limits scalability, restricting revenue growth compared to brands that expand supply. Its reliance on ultra-wealthy consumers makes it more vulnerable to economic downturns, unlike mass luxury brands with broader audiences. Rising ESG concerns, particularly over exotic leather, challenge Hermes's heritage. While competitors like Stella McCartney embrace sustainability, Hermes must balance tradition with evolving consumer expectations. Customer loyalty and scarcity-driven demand are key strengths, but slower digital adoption puts Hermes behind LVMH, which leads in e-commerce and AI-driven luxury. The resale market boosts desirability, with Hermes's products appreciating in value, unlike other luxury brands. However, this also heightens counterfeiting risk, requiring strong brand protection. Hermes's WACC 7.58% is significantly higher than GSK's 4.25%, driven by risk exposure and capital structure. With a beta of 1.07, Hermes's cost of equity is 7.63%, reflecting greater market volatility, while GSK's lower beta 0.38 results in 4.47% cost of equity due to its stable market. Hermes is 99.16% equity funded, whereas GSK uses 21.21% debt, benefiting from lower cost financing. Debt is cheaper due to tax benefits, but Hermes primarily relies on lease liabilities, which don't generate explicit interest expenses like traditional debt. Without corporate bonds to reference, we use the 10-year French government bond yield, 2.73%, as a proxy for Hermes's borrowing costs, reflecting its strong financial position and low credit risk. Since debt is just 0.84% of Hermes's capital structure, its WACC is almost entirely equity-driven, making it highly sensitive to market fluctuations, economic cycles, and brand exclusivity, unlike GSK, which benefits from stable demand and lower-cost debt financing.
LVMH shares key industry risks like economic sensitivity, brand reputation, and supply chain challenges. LVMH specific risks include overexposure to the Chinese market, making it more vulnerable to tariffs, regulations, and shifting consumer demand. As a luxury conglomerate with more than 75 brands, it also faces a lot of internal competition. Lastly, counterfeiting and intellectual property protection pose significant challenges as LVMH is a prime target for counterfeit goods and therefore demands ongoing legal efforts. When comparing LVMH's WACC to GSK's, we see that LVMH has a higher WACC of 6.62% compared to GSK's 4.25%. This is mainly because of LVMH's higher cost of equity, 7.13%, which is driven by its higher beta of 0.96, meaning it is more sensitive and exposed to market fluctuations. In contrast, GSK has a lower cost of equity, 4.47%, as its beta is only 0.38, making it less sensitive to market fluctuations. In terms of capital structure, LVMH relies more on equity, 89.94%, while GSK uses more debt, 21.21%, which helps lower its WACC due to the tax benefits of debt financing. Additionally, GSK's cost of debt is higher at 3.90% compared to LVMH's 2.86%. This is largely due to industry regulations and credit risk differences. The risks underlying Hugo Boss include that it faces pricing pressure since it competes with both high-end luxury and affordable fashion due to its middle market positioning. Unlike most luxury brands, it relies heavily on wholesale distribution, reducing control over brand image and increasing exposure to third-party retailers. Investments in long-term rental agreements and new store concepts may not deliver expected returns, adding financial risk. The company is also highly exposed to the European market, making it more vulnerable to regional economic downturns compared to brands with stronger US and Asian footprints. Hugo Boss has a WACC of 5.94%, higher than GSK's 4.25% due to higher market risk and borrowing cost. Its beta of 0.76 pushes its cost of equity to 6.21%, reflecting the volatility of fashion, while GSK's lower beta, 0.38, keeps its cost of equity at 4.47%. Hugo Boss also faces a higher cost of debt at 6.36% versus GSK's 3.90%. This is mainly due to its lower credit rating, BBB versus GSK's A. It relies more on equity, 80.82%, which is more expensive than debt, further increasing its WACC. Despite GSK's slightly higher cost of debt from industry regulations, its heavier use of debt keeps its overall WACC lower. The risks underlying Prada include that it must constantly adapt to shifting consumer trends, as the luxury industry is highly influenced by cultural changes. Falling behind can weaken brand relevance. Luxury demand is also sensitive to economic downturns. Reduced disposable income leads to lower spending on high-end goods, making Prada vulnerable during recessions. Production disruptions pose another risk. Shortages of premium materials and potential labor strikes can delay production and increase costs, impacting profitability. Prada's WACC is 5.09%, higher than GSK's 4.25% due to greater market risk and a more expensive capital structure. Prada's beta of 0.64 drives its cost of equity to 5.66%, as luxury fashion is more volatile. In contrast, GSK's lower beta of 0.38 keeps its cost of equity at 4.47%. Prada also relies more on equity, 83.44%, while GSK uses more debt, 21.21%. Since debt is cheaper, GSK benefits from lower financing costs. While GSK's cost of debt, 3.90%, is slightly higher than Prada's, 3.26%, due to industry regulations. GSK's greater use of debt helps keep its overall WACC lower.
Now I will examine how the firm's WACCs compare and whether changes in equity or debt influence their attractiveness. A higher WACC does not necessarily mean a better deal. WACC reflects both risk and return expectations. In the luxury goods sector, firms like Hermes, 7.58%, and LVMH, 6.62%, have a higher WACC, indicating potential for higher returns but also greater risk and volatility. On the other hand, GSK has lowest WACC at 4.25%, reflecting a more stable, lower risk investment but with limited growth potential. From an investor's perspective, those seeking higher growth may prefer luxury brands, while more risk-averse investors may favor GSK. This highlights how WACC can guide investment decisions based on risk tolerance and return expectations. This slide examines the impact of doubling equity on the WACC for the four firms. The data shows that increasing equity leads to a WACC going up for all firms, though the magnitude varies. Hermes experiences only a 0.03% rise as it is already very heavily equity funded, making the change negligible. In contrast, Prada and LVMH see the largest increases at 0.26 and 0.24% due to their higher reliance on debt. Firms with more than 10% of their value in debt are more sensitive to shifts in capital structure, as equity is typically more costly than debt due to tax advantages. Overall, the results highlight that firms with higher debt levels experience a greater increase in WACC when equity is expanded. Finally, we examine how doubling debt affects the WACC across the four firms. Unlike equity, increasing debt reduces WACC due to the tax benefits associated with debt financing. Hugo Boss experiences the largest decrease at 0.96% as it has the highest debt allocation. LVMH and Prada also see notable reductions of 0.61% and 0.72% respectively. Conversely, Hermes shows a minimal change with only a 0.04% reduction. This is similar to when equity was doubled due to the already high equity allocation, so even a significant increase in debt has little impact on its overall capital structure. In summary, firms with higher proportion of debt benefit more from increased leverage, leading to greater reductions in WACC.